All right, folks. First of all, we have the Monday range model. Now, some people on the internet claim to teach it, but every single teaching about this model is incomplete. All of them. The reason being is that they don't understand that candles are ranges. All right, so Monday's a range, Tuesday is a range, and Wednesday's a range. Each range has its function. Right? When trading the Monday range model, apply range trading rules on the Monday candle. So Monday, accumulation. Tuesday, turtle soup. Wednesday, continuation. The Monday range is either going to be turtle souped, falsely broken out of, or it will be broken through and used as a key level. So break and retest, basically. Right? There is no other state or condition that can happen. Right? It's either going to be turtle souped or it's going to be broken out of and reused as a support or resistance level. Right? The true support and resistance level is ranges. Target 1 is always going to be 50% of the Monday range. Target 2 is the opposing end of the range, right? So in this instance, you have this candle, you mark it out. Okay, turtle soup. As soon as you see this this rejection, right? Range, turtle soup, and rejected back into the range, you target 50% and the opposing end of the range, right? Every single time. This allows for reevaluation and potential mistakes in your analysis, either by reversing higher or dumping much lower than you thought. Right? And that's where runners come in the next lesson. Here's a visual representation. So you have Monday, one specific candle, turtle soup off Monday on Tuesday, and then you hit the opposing end of the range on Wednesday, right? So you got Monday, range, turtle soup, target 150%, and you'll usually see this consolidation, right? The infamous consolidation in the equilibrium. Now, here's a side quest. What does that mean? What does a consolidation mean? It means that an expansion is coming. So when you say that price consolidates in or at the 50% of any range, that means price is going to expand from the 50% of the range. All right, some food for thought for the astute pupil. And by the way, market structure traders, right? You got this beautiful breaker, got completely wrecked because they don't know the candles or ranges, right? Monday, range high, target 1, range low. If you only focused your entire trading career from now on, from this video onwards, if you focused on only taking trades from the end of the range to the 50%, then you'll have a much higher win rate. Another example, one specific candle is Monday, right? It's a range, chop. When you see a large wick on either end of the candle, that means there is a lot of chop, right? So this one candle, turtle soup, on Tuesday. So open here, massive rally, everyone gets suckered in. And as I'm saying this, visualize the lower time frame, right? Monday, turtle soup on Tuesday, and then within this specific range, Wednesday gets the low, right? They have an inside candle, which means probably an expansion happened afterwards. Another example, you got Monday range, Tuesday turtle soup, target 1, and target 2. It's the same candle, by the way. Right, so Monday, chop. Tuesday, this gray area gets turtle souped. And then on Wednesday, you get a classic sell. An easy day to trade. Now, market structure works within this framework. Breaker, false. Model number 1. Market structure shift, wrong. Monday range. The market structure shift that is in the direction. See, market structure works, right? In fact, I use it. And you should use it too. But market structure that is in the direction of the higher time frame only. Right? So, Monday range, turtle soup, breaker right here, right? High, low, higher high. Break through this breaker, right? The closing price. And this one specific down close candle before the purge is the key level. In the light of the Monday range, right? So you're using structure within the higher time frame order flow. That's the most accurate, and that is the flawless way of trading market structure instead of randomly trying to catch every single shift you see. Of course, beautifully, the closing price of the breaker gives you an almost zero drawdown entry every single time. Beautiful. And a breaker is one that takes out a previous candle's high and probably takes out 1 and 2 highs. That's better than the one that takes out 1 high. Next up, you have the Monday range, broken through and used. All right, so Monday, broke through it, and turtle soup. If you notice, there was not a single bullish market structure shift, right? So we're breaking through lows. Because remember, you have to blend market profiles. It's the first chapter for a reason, the first technical chapter. Right? You have to blend market profile with this. And if you do that, then you will have a flawless system. Right here. Did we ever break through a high that broke a low? Right? Nope. We wicked above it. That's bearish continuation. Lows broken, highs rejected. This was the chance they had to break above the high. If they break above this high, right? Low, high, lower, low. If they closed above this high, we're bullish. Right? That's market structure. Otherwise, we're bearish. Rejecting highs, breaking lows. So let's assume you don't see this part of the screen, right? Would you buy this blindly? Yeah. You can buy this as this one specific candle, turtle soup, 3-candle model, to the 50%. That's where the magic happens. Right? And watch this more than once. The astute pupil, the smart student, the diligent disciple will lose sleep over this, right? Because what I said just now in the past 5 minutes is literally all you need to know. To be smart and take this into your own charts, verify, and enjoy. Next up, you have the Asian range model, right? Asian range model. So you have a consolidation from 8 p.m. to midnight, New York time, right? That's the Asian range time. So you take that specific time because here's a little side piece on the 3-candle model. If you pattern trade it, you'll get wrecked, right? Because not every single candle is going to be turtle souped, obviously, right? So price ranges, you got price ranges, you got time ranges. This is a timed range, right? So from 8 p.m. to midnight, New York time, that's the range I'll use to measure what happens. Do we break out? Do we turtle soup one side? What happens, right? Now, some market structure study for you here. high, low, high, low. Notice the highs, the lows, excuse me, so we're bullish, right? First of all, lows rejected, highs broken, right? And more specifically, the lows that took the highs rejected, super important. Low, high, low. Breaking the high, close above, bullish, right? We're breaking above the high that broke the low, and then digging back into it, and then rallying, right? That structure. Here's another chance. High, low, higher high. We never broke below this low. The high that broke the low is key, and take this into your charts, right? The high that broke the low is key. This is classic Dow theory, right? But when you look at it and blend it with market profiles, then what you have is a deadly weapon in your hands. Low, high that stabbed into the low, broken through, bullish, right? So dumps are for buying. Within this, you have another one. Low, high, low, break above it, dump below, buy. Model number 1, by the way. This one specific candle, down close candle, is a range, right? This one too. And in a bullish market, the highs, the lows that broke the highs are turtle soup, and vice versa. All right, listen to that again. And we kept going up until we got a high, a low, a higher high. We broke through the low that broke the high. That's when the downfall started. At this point in time, right, that's what happened. Obviously, a better entry is this, right? You see this? It's a more advanced entry. This is the 3-candle model up here, right? Candle, range, order block, CSD. Close below, lower prices, right? So these two things I'm giving you are the most mechanical ways of determining bias. The highs that broke the lows, and the lows that broke the highs, and the closing of the candles above and below the previous candles. That's all you need to know for bias, right? That's the fundamental basis of bias. So your homework is go into your charts and look at the relevance of the highs that broke the lows and the lows that broke the highs in determining bullish or bearish bias. Some more thoughts. Traditionally, these highs that broke the lows and the lows that broke the highs, they're used to determine bias, right? What does that mean? That means from the moment you close below this low, right, you displace below it the low that took the high, or vice versa. If you break below it, then from this moment in time onwards, you're going to target the previous lows, expecting a retracement, targeting the previous lows, right? You can also use them for turtle soup. Low, high, lower, low. Never closed twice above. Never. That's turtle soup. So you can use these highs for turtle soup, or you can use them for determining the trend, quote unquote, determining are we more likely to go higher? That's what you determine, by the way. You're determining the answer to this question: are we more likely to go higher or lower? That's all. You probe the highs and lows. The highs and lows in general, these specific highs and lows in specific. And of course, a beautiful, never close the body above this candle, just gorgeous wick, non-existent, right? The wicks do the damage, and bodies tell the story. Just beautiful. Never ceases to astound me the accuracy of algorithms. And yes, it's not one algorithm. There's many. Next up, Asian range, right? Timed range from 8 p.m. to 00:00 a.m., right, midnight, New York time. You wait for one side to be taken, right? And then you determine a continuation or targeting the low of this session as soon as you get a shift in direction, right? High, low, smash above it, and displace below. You got this one too. High, low, higher, high, smash below. This is objective, right? Smash below it. Then use the FVG to target this low. A timed low. Everything is timed. Another note is that I'll leave that in the chat. All right. So remind me in the chat. Talk about the IRL versus ERL and which one to use, basically, because it's being thrown around on Twitter nowadays and being used incorrectly. So I'll touch on that in the chat. All right, so that's it. Now, a pattern trader who didn't have the Asian range in mind is going to buy above this high. And that is exactly the previous highs turtle soup, right? Range high over here, turtle soup, and range low. All right, so that's the basic summary, and that was a mouthful. That was a dense, super important, very crucial past 10, 15 minutes. Not sure. But watch them properly and apply them in your charts. Go to your charts. Don't just watch this and expect it to magically work. Watch this. And I'm advising you, the viewers, the same way I'd advise my brother or sister, right? Or any family member who wants to learn how to trade. Whatever I'm saying, take it with a critical mind. Go to your charts and verify. That's how you gain confidence. That's how you know what? I've seen it myself. I've seen it happen once, twice, 3 times. And backtest, the history of the charts is gold mine, right? Because history does repeat itself. When you buy an order block, right, you're expecting history to repeat itself. The pattern to repeat itself. Why? Because smart money dumped price below this low. Because they control the markets, obviously, right? And they used this one specific candle to scare everyone away, and they're going to buy back into it and rally, right? So it's a repeating logic, and it will never stop working. As long as you have the right to trade, these concepts will work. So if that's your concern, then rest assured that they will work as long as, at least till 2030, that's for sure. But the takeaway is this. Take all of this, right, apply it in your charts, get used to it, and that's when the money making happens. Candle. This one specific candle is a range, right? Gray area. It's going to be a timed range, obviously. This range is getting turtle souped. This is a lower time frame look into the higher time frame candle. Right, so the candle in the higher time frame looks like this. And on the lower time frame, you'll see this. So you're going to target these highs as soon as you determine a change in the trend or direction. Obviously, you're going to take the trade from down here to up here. And excuse my voice, I'm unwell today. range low, range high, within a range high and range low, right? So there's tons and tons, and there's tens, 20s, there's hundreds of opportunities per day, right? Range low, range high, turtle soup. You take it to the range high and then you wait. Did we close above the high that broke the low? Nope, right? Okay. Yes, we closed and we created a bullish PD rate above the high, right? This order block right here. Bearish order block, fake, devoured, and these are the best order blocks. The best order blocks are the ones that have a failed order block before them, right? So let's assume everything after this candle is invisible, right? This bullish engulfing candle. Turtle soup. If you're a pattern trader, you are a bearish turtle soup, but you didn't look at the high that broke the low. We closed above it. We're bullish, right? Low, high, lower, low. Breaking above the high that broke the low, and I want to drill this in your head, right? From then onwards, we rallied. Rejecting lows, breaking highs. Simple and advanced market profiles. Candle range, turtle soup, and you sell the next candle above the open. It's that simple. Right. One more thing. Before a true breakout of a range, you will normally have a fake turtle soup like this. You know, some of you tell me that it's usually the off-the-cuff remarks that hold the most value, and that's true. Next up, you have model number 1 plus. So in simple terms, you got a high, you stab into the old high with an up-close candle, and that is your entry level. No, it's not supply and demand. Supply and demand doesn't require you to stab into an old high, right? Nowhere in the book of supply and demand does it say you have to stab into an old high. It does say that you have to have a rally, right? And a rally does come from a key level, but it's not as precise. Nothing is as precise as this. And vice versa. You got an old low, you stab into the old low with a thick down close candle, explode above, and use that thick down close candle to rally again. This is also a range, by the way, right? Range low, range high. You wait for this to form, add the range low, range high. Everything's connected. Everything you learn and everything I teach you is connected, and there is not one single contradiction. And this is a challenge for the skeptics as well. In the concepts, everything is complementary, right? Nothing is contradictory. That's a bold claim, but it's true, right? And if you don't believe that, then verify. Again, over here, you have a higher time frame key level. This is the full picture, by the way. So a simplistic view is this. High, in the most basic terms, if I was to trade one model as a pattern, it would be this. All right, so for the simple minds, those of you who don't want to complicate their lives too much, right? This one is for you. High, stab into the high with an up-close candle, close below it. As soon as you close below this candle, you got to sell. All right, is that simple? And vice versa. You got an old low, you stab into it with a down close candle. As soon as you close above the candle, you got to buy. If out of all these videos you take this away, then you've done a good job, right? For the most lazy of the lazy, And now for the rest of you who want to go and look deeper, it's always going to stab into the old high after the opening price of the new candle. There's always going to be a higher time frame key level that leads to the expansion, right? And multiple highs are better than one high, and the highs from the previous candle are better than the current highs, and vice versa, right? Key level, stab into the key level, and before you hit the key level, there's always a range, and there's usually a market structure shift. Don't always bet on this, but there's always a range, right? A higher time frame key level, lower time frame range, stab into it, order block, rally. Order block, the thick down close candle that stabbed into the old low. Here's a chart example. Thick up close candle that liquidated an old high. High, low, old high, thick, heavy, high volume, up close candle. As soon as you close below this, right, you can look here as a point of interest to sell. And then, of course, you can sell a continuation over here. And vice versa. You have a low. You stab into the old low with a thick down close candle, a red candle, right? This one specific candle is the candle that causes the rally. This one specific candle is the candle that causes the dump, right? This one specific candle is the one that causes the rally. Close above, confirmed. Stop loss below the candle, or above the candle, and target the old highs. Yes, that's a wide stop loss, and yes, there are ways to refine it, obviously. Such as the high that formed, the swing high that formed into this key level is a stop loss, and vice versa. Moving on, how to trade model number one. Mark the opening price, wait for price to print a thick up close candle into an old high, or a thick down close candle into an old low. Wait for them to close above the down close candle or below the up close candle. Enter at the specific candle's high or low in the direction of the higher time frame order flow as everything. All right. So here, for example, down close candle that goes into an old low, close above higher prices. Down close candle over here, this one specific candle. It's always one specific, it's not a zone, it's not an estimated area, it's not a guesstimation, it's one specific concrete candle. Over here, use this one candle to rally, and vice versa, right? This thick up close candle is stabbing into these old highs. When you close below it, it's the key level that causes the rally. This one candle is causing the rally. This one candle is causing the rally. This one candle is causing the rally. And here's a note on how to backtest. First of all, you check where it works, right? Because you might say that, you know, for an example, you can't. Downwards candle. Let's look at an example that failed. I'm trying to. Old high, up close candle, dump. Right. Let's just say that it fails sometimes, right? That doesn't matter. The point is that you first have to accommodate yourself to seeing what it looks like when it succeeds in backtesting. That's step one, right? And then you try it out live, right? The specific times that it worked correctly, you mark that out. and you try it in real time. It'll work most of the time, and sometimes it'll fail. That's when you study the failures, right? But when you backtest, then you have to have some sort of bias to the idea, because you're trying to accommodate yourself to what it looks like first, right? Of course, you'll fail sometimes. That's inevitable. Yes, even I get it wrong sometimes. That's quite rare, but it happens, right? But first, get used to the right thing. If you don't know what the right thing is, then how can you determine what the wrong thing is? Right? So in summary, all that rant, backtest when it works 1,000 times. And then try it live. If it works, great. Mark everything. More on journaling in the next chapter. If it doesn't work, then mark why it didn't work. It's that simple. Right, again, high, low, higher, high, lower, low, turtle soup. Remember? And this one specific candle is the one used to rally. The pattern, model number 1, will occur with the order block being created, stabbing into a previous candle's high, or a range being created with the order block stabbing into the current candle's range, high or low. First case, the order block being created, stabbing into a previous candle's high, such as here, or low, right? You have the previous candle's low being stabbed into and closed above. Previous candle low, stab. One specific candle causes the rally. Previous candle's high, stab into it, close below, confirm. One specific candle causes the dump. Or it can be within the same candle, right? Like you got it, you have an example over here. High, up close candle stabbing into the high, close below, and you can see that they used it to dump, right? So it's either going to be an old low of a previous candle, right? Open, power of 3. Everything feeds back in the power of 3. Open, dump, old low. When the higher timer is bullish, then you get a rally, right? And this is model 1, below the open. You're bullish, wait for the open, you wait for a range to form, and then model 1 to form within that range, and rally, right? Below the open again. When you're bullish, you buy below the open. You look for the pattern below the open, and vice versa. Entry trigger. Close below the candle that liquidated the higher low. No trigger, no entry. Right? You have strict rules to your model. It tells you when to stay out, and it tells you when to participate. Right? If there is no close, you have no trade. High probability times for intraday, because a lot of you are a fan of scalping and short-term daily range trading, are 3 to 5 a.m. and 9 to 11 a.m. on the 15 and 5-minute time frame. Finally, and this has been a long, interesting lesson, a quick buck model. In the most simple terms, trade the candle after the candle that hits the key level. Because the candle, and focus with me here, right? Hopefully you've been focused during the entire thing, because not a single word was out of place. Everything is deliberate, nothing is random, right? So focus. And if you weren't focusing, watch it again, and again, and again, with a notepad and pen in hand. You need to be writing down everything. Your thoughts, what I'm saying, the summary of what I'm saying, what your questions are, what's your doubts, everything written down in paper. Right? There's a saying which is, knowledge is a prey and writing is the net. Secure and catch your prey with thick nets, thick ropes. It's an Arabic saying. العلم صيد والكتابة قيده قيد صيودك بالحبال الواثقة. Right? So write down the important stuff. Trade the candle after the candle that hits the key level. If bullish key level, buy below the open of the next candle. Right? If bearish key level, then sell above the open of the next candle. This model is basically trying to catch the ICT classic buy or sell template, right? And I didn't call it the classic candle on purpose because there's many ways to catch the ICT buy and sell template, right? One of them is this. What the essence of the ICT buy or sell template is that when bullish, in an ideal scenario, you buy below the open, they open, you get one trade here, trade number 2, trade number 3, a classic buy candle. Or you get a classic sell candle, right? Open, rally, sell, decline. How do you catch this? Because if you can catch 4 of these a month only with high accuracy, then that's all you need. That's 4 days of work, the entire month. Right, but how do you catch them? By trading the candle, and this is one of the ways, by trading the candle that, not the one that hits the key level, because that one's usually a choppy candle, right? The one after the one that hits the key level. So you see chop, chop, chop. Everyone's complaining about the markets being volatile and choppy, right? Everyone's losing. And then you get one smooth candle, right? And this is what everyone's trying to find out. This model is a basic method of how to find it. There are more advanced techniques on how to identify this to the pip, right? And know exactly when, where, and how they're going to happen. What does that mean? That means I'm telling you that there's methods out there which allow you to know exactly when this happens. Open, rally, dump. Or open, dump, rally. That's a more advanced topic for later, but the most basic way to achieve this is through what I'm showing right now. A visual representation. You got candle 1, candle 2. Key level is hidden in this one, right? And the most volatile and easy to trade candle out of all of these, I'm sure you can agree, is this one. Right? Also has a model number 1, by the way. Right? Old high, thick candle, close below, dump. This one specific candle is responsible for this entire dump because it happened at a key level. Right? Important high, a quick revision, right? High, lower low, higher high, break, bullish, right? Bullish. First sign of bearishness, second sign, and dump. OTE buyers all wrecked. Right. Again, you mark the FVG, right? This candle touches the FVG, your key level, and the next candle is a classic sell. Close below, right? Key level, assuming there's an old high, and there is, and this is a chart you should be familiar with. It's a higher time frame, important asset. chart, excuse me. Candle number one, chop, and the candle after the one that touched the key level is a smooth sailing. Right, so in summary, trade the candle after the candle that hits the key level. This allows you also to confirm the key level because the structure on the lower time frame that you see on the candle hitting the key level will reveal the intention of the candle after that one. Right, as always, if it's a bullish key level, buy below the open of the next candle. If it's a bullish key level, then you simply open, sell, dump. Excuse me, open, rally, sell, dump. Right? And remember, everything feeds into the power of three. Everything you ever study, ICT, Turtle Soup, SMC, it must feed back, even the details, right? When I give you details, like for example, by looking at this chart, you already know the candles are ranges, and this one range has been turtle souped into a key level, and is the second candle after touching the key level. So you expect smooth sailing, right? Now, I'm aware that some of this may be too advanced for some of you. And if that's the case, then go back to the old stuff. Go back to the previous lessons. Look into your charts. If you don't understand something, it's your fault. Because you haven't looked at it deep enough. You haven't seen it enough times. If you're confused about a concept, then you simply haven't experimented enough. Right? It's always your fault. If you lose, it's your fault. If you win, it's your fault. If you understand, it's your fault. If you suck, it's your fault. If you lack mental ability, it's your fault. You can fix that. Whatever state you're in right now is your fault. Right? If all of this is smooth sailing and you really found this eye-opening, well, it's your fault. It wouldn't be a fault in that case because a fault is a negative thing, but it's due to you, right? Thanks to you, it happened. Obviously, I am facilitating this to you, right? I'm making it easier. I'm giving you advanced tools to go and potentially extract money from the markets. But the application is on you. Right? So, just a side note, addressing those who might find this complicated. It's supposed to be complicated. And you're supposed to go and experiment and try once, twice, 10 times, 100 times, 1,000 times. And eventually, you'll get it. Right? So, power of three. Open key level rally. Open SMT rally. Open range rally. Right? That's all you'll ever see. This is the lens through which you see the charts. Model 1 here, right? But Model 1 came following power of three, right? Power of three doesn't happen because of model number 1, right? Model number 1 happens because of power of three. And this has been a long lecture. My voice is getting raspy. My throat is hurting. It's been hurting for a while, but I'll keep going. Right? The common denominator in all of the trades you've seen me take in any successful trade you ever see, right? If you see someone trading Elliott waves successfully, then he's trading the power of 3 without knowing it, right? Everything boils down to the power of 3. If you trade a breaker successfully, then you're trading the power of 3. If you trade market structure successfully, and yes, they exist, then you're trading power of 3. Whatever you trade, if it works, it worked because of the power of 3. SMT, power of 3. Key level, power of 3. Range, power of 3, right? A range is literally it's the embodiment of the power of 3, right? Accumulation, manipulation, distribution, right? So everything has to feed back into this, whatever you study. And it's the most simplistic summary of the markets. This is ICT in summary. Open, key level, rally. When you're bullish, open, dump, rally. When you're bearish, reverse this. Open, rally, dump. So it's going to keep dumping lower. It's going to stop at the key level and rally. It's going to keep dumping lower. It's going to stop at an SMT and rally. It's going to keep dumping lower. It's going to stop. It's going to range and then rally. Right? And each one has its own entry methods. And more in depth on entry techniques in the next chapter. Right? So everything feeds back into the power of 3. All of it. It's always going to be a candle opening, previous high, declining. Now, you can go crazy chasing and pattern trading power of 3, obviously, right? You'd need to be really stupid to do that, right? But it's possible. So always bear in mind the higher time frame, draw liquidity. That will help you trade the important candles. And that concludes this lesson. It was heavy and dense, and I suspect for some of you, it's going to be the most fun one, right? Because I dropped some things which I hadn't spoken about before, neither in public nor in private. So enjoy. I hope you found it insightful. I wish you good luck, good trading, and see you in the next one.